after yesterday, after the last few weeks. I'm sure Danny shares that view. Danny Blanchflower joins us now, the Dartmouth professor and former member of the Bank of England Monetary Policy Committee. Danny, the Bank of England, inflation year over year, double digits, people looking for a rate hike. Do you think that's the wrong move today?
Well, I do, as you might imagine.
Well, I guess.
There was some news yesterday, which was inflation rose more than folks think, but that's gone, that's passed. We're supposed to be focusing on what's coming. There's a major credit crunch, and the reality is that the Bank of England, in its forecasts, is forecasting no growth whatsoever for 3 years, inflation below the target, and we've just had a huge fiscal tightening. So basically, guys, assume they're going to raise. Everyone thinks they will. And what we're going to sit and watch here is disaster coming. Feels like 2008 all over again. Who's holding what bad stuff? Presumably in the UK, with the mortgage markets now in disarray, we're going to start to see banks holding bad mortgages, like that people can't afford to pay. So I think this is the peak. This is a huge mistake. I would have been voting for big rate cuts. And what you'll see in the United States and the UK is disastrous data will show, and central banks will then move into panic mode, as the markets are pricing in already.
Danny, 25 is the wrong move. So let's talk about the Federal Reserve. Was that the wrong move yesterday?
Well, I think so too. I mean, we're seeing inflation now clearly has peaked. I mean, the question is, to what extent is this credit crunch a big deal? I mean, our pal Torsten Slot thinks that it's the equivalent of about 150 basis points of tightening. That's probably true. So this is a new set of tightening over where we were. The Fed has actually been entirely guessing. There is no economics to base their claims that this would be a soft landing. So you keep going and you keep going, but outcomes come about 18 months later. So the question is, what is there out there that we don't know? And you reported so well on Credit Suisse and the $9 billion that UBS had to receive to kind of make up for what's hidden under the hood that we didn't know. So at these times, you should be cautious as to what's coming on the downside. It's hard, I think the only question is, how bad is it going to be? So this looks like a wing and a prayer. We're going to carry on raising rates. Well, let's wait for some data to come. And my assumption is that it will start to come. I mean, the markets think it's going to come. I mean, Powell says, maybe we'll raise rates, but look at the Fed Watch tool. CME's Fed Watch tool says markets are pricing in 3 cuts by the end of the year. So why would you raise when the markets think you're going to cut? So we're in confusion. We're absolutely in confusion. And it really feels like 2008. In the UK, we rescued Northern Rock, thought that would solve everything. What happened was Bradford and Bingley Alliance and Leicester failed, RBS failed, all about 6 to 9 months later. So watch this space. This was an error. Shouldn't have done it. There is no economic basis for anything that they're doing. And the real economy is what's going to matter. And wage growth is a big deal. That's not picked up in the way that they thought. But really, the real economy is
Danny,
what we're going to.
I have to cut in here because a lot of people are listening to what you're saying and saying, really, like 2008, banks aren't as leveraged at all. What you're dealing with is a liquidity crunch, not a credit crunch, at least not yet. And you're talking about assets that are backed by sound loans, not necessarily mortgage debt that was taken out by somebody with no income and who put nothing down. So this is a very different kind of scenario than it was in 2008. How do you push back against that and say that this is comparable?
Every credit crisis and every housing boom, for example, the standard thing that everybody says is this time's different for a variety of reasons. Yep. This time is different. It simply can't happen again. I mean, it's not just about that, Lisa. I think it's about confidence, remember. It's about confidence that the banks are whole. It's about confidence that my deposits are safe. And Janet Yellen, I think, made a huge error yesterday. I mean, her error was actually answering the question. So now we think, you have $1 million in some regional bank. What should you do? Well, obviously, you should pull that money out. If it's not guaranteed, then you should pull it out and take it to Bank of America. So that looks like an error, but it's about confidence, Lisa. And each time in the history of crises, everyone says this time is different. And I think the other thing is that, I mean, as you say, you guys have reported on it. What did UBS see under that hood that we don't know about? So I think that's a great deal of it. I mean, remember, as I say, in 2008, who would have thought in August 2008 that RBS would fail 2 months later? I think I think it's these kinds of surprises.
Let's put the
I
banking.
could be wrong, of course, but I think you have to be mindful that this is a giant credit crunch.
But let's put the banking crisis aside for 1 second, the known unknowns, the unknowns, whatever you want to call them, and just take a look at what the data was showing before this particular meeting, this sort of perhaps backward looking, but hotter than expected inflation data that was persisting in the US as well as in the UK and other European nations. From your perspective, have you been surprised by how sticky inflation has been, how long it has taken to show signs of coming down? Does that get you concerned at all about where we're heading in terms of Fed policy being used as a tool for financial?
The way she said, does that get you concerned at all? Sounded like she was asking him, does that get you excited at all?
It's obviously because there are shocks. In the UK context, there's shocks imposed by Brexit. But again, go to August 2008. What you said was essentially what people said then in August 2008. Inflation was 5.5%. Within 9 months, it had gone to deflation. And what we're seeing in the United States is those base effects are dropping out. Certainly, if you look at the unseasonally adjusted inflation numbers, they're really very, very low. I mean, a lot of actually what you're seeing is about this weird technical thing about the seasonal adjusting. So really what we're talking about is inflation's high because of the way they've seasonally adjusted using new methods. So I think the answer is that look at the wages. Wages have not picked up in the way that people thought. Wage growth has been relatively benign. I mean, it's hard to read the data, Lisa. I mean, it's as if people think we have a nice playbook. We have never seen anything like this other than the Great Recession. Every piece of data since 1945 to today is utterly irrelevant. We have to look at other crises, and what you'll see is then suddenly inflation plummets. So I think that's what's coming.
Danny, I've got to squeeze this in. Just 60 seconds left. If they came out and offered blanket deposit insurance, would your view change?
Probably would, actually. I mean, I think in a sense, the answer then, John, is that wouldn't the Bank of England and the Bank of Canada and the ECB have to do the same? But I do think that the blanket deposit insurance would really be a help. Certainly think that.
Danny, thank you, sir, for catching up with us. Danny Blanchflower.
Okay, that was awesome. Let's break that down because there was a lot of information in that. This guy, this is a top G right here. And I don't mean like a top G like somebody who's stuck in jail. I mean like a finance top G, okay? So basically an old white guy. Okay, so what do we have? Well, look at this. So first of all, this is the inflation that Jerome Powell was talking about yesterday. Unfortunately, during the intra-meeting period, coming in a little hotter than expected. And really, this idea is that if you look at averages over the last year, yes, inflation is trending down. That's fantastic. If you look at averages of over the last, say, 6 months, okay, yeah, inflation also, oops, let's go ahead and make the line actually go the way there we go. It's also trending down. That's fantastic. In fact, the way you would probably draw this average is something more like this, since these low points right here would drag the line down, right? So that's probably more of the moving average that you're looking at right now. The problem is this little pickup that we got right here. Why, if we now look at just the last 4 months, are we trending up on basically core CPI on a month-over-month basis, right? And this is what's creating some concern for Jerome Powell. Now, I think this individual makes a very good argument, is that Jerome Powell is so concerned about what these CPI and PCE numbers are showing. PCE is the Fed's preferred method of CPI. It's basically the same thing, a little different with weightings. But they rely so heavily on these seasonal adjustments, and their weightings are based on some weird things. The weightings used to be based on an average of 2 years of data. Now they're based on 1 year of data. Then at the end of every year, we change the weightings. Everything's a complete disaster. Everything completely changes, right? So what's remarkable about that is you have this individual suggesting Jerome Powell's convincing fight against inflation is what's probably going to destroy our economy. Now, that means recession. In fairness, Jerome Powell kind of alluded to us walking into a recession yesterday. In fact, I would go as far as saying Jerome Powell basically yesterday told us the recession's confirmed, folks, buckle up. There are a few reasons for that. Number one, Jerome Powell, when asked about the soft landing, basically said, yeah, there's a path. We're trying to find it, but basically it's not happening. We're going into recession. So Jerome Powell realizes we're going into recession. Beyond that, look at this chart right here. This chart shows Jerome Powell's front end of the yield curve. It is called Jerome Powell's favored recession indicator. And based on this, it has always been correct in the past. We are going into recession. When this sucker inverts, a recession follows within 18 months. And Jerome Powell realizes that. Now, obviously, markets change their opinion of what's going to happen with either rate cuts or rate hikes based on data. For example, there's somebody in the chat here saying, Kevin, you initially thought 2023 rate cuts would happen. Then you said they wouldn't as market priced no cuts. Okay, you have to remember, when I'm reporting whether rate cuts are coming in 23 or not, it's based on what the bond market is telling you. In fact, I provide you the data of what the bond market is showing you and showing you the charts saying, hey, this is what the market's pricing in. Right now, the market is pricing in 100 basis points of rate cuts for 2023. This is the same thing that was true in November of 2022. The problem was in January and February, all of those rate cuts went away because inflation started running up. Then we had a banking crisis, and then the rate cuts got priced in again. So, like, you have to be careful how you analyze this data. I want to make it clear to the people watching that whether we're having price cuts or rate cuts this year is kind of like watching a stock move. One day it's red, one day it's green. This stuff is changing every single day. And what we're trying to do is pay attention to what's going on, because there is a really weird gap right now between expectations of what the Federal Reserve is going to do and expectations based on what the bond market thinks. Look at this particular chart right here, okay? On the right side, you have these little dots. I'm going to highlight them in green. This right here in green at the top, over 5%, 5.1% is where the Fed thinks we're going to end up having Fed policy rates for the end of the year, right? That's where they think we're going to be at the end of the year. Well, look at where they think we're going to be next year. I'll highlight it in pink right here, right there, at about 4.6%. Fantastic. Well, what is the market pricing in for a terminal rate? That is the highest rate we're going to get to. Well, the market is pricing in that we're going to be somewhere around, by the end of the year, 3.94% by the end of the year. Well, that's very different. That's actually substantially lower than both of the dots provided by the Fed. Well, why is that? Well, it's because the bond market is trying to price in this idea that, crap, we're probably going to go into a recession. Now, at the same time as we're probably going to go into a recession, and even Jerome Powell's indicator suggests we're going into a recession, the reality is Jerome Powell basically has to be dishonest to us. This is what this guy was saying. The guy was saying Janet Yellen crashed the market yesterday because she was honest. Look at this. And I remember this yesterday because I was pitching the coupon code for the programs of Building Your Wealth link down below, where you get lifetime access to everything from learning how to be a millionaire in real estate, going from zero to millionaire. You don't even need anything to get started. You got stocks and psychology of money. You've got the Elite Hustlers group, learning about liability and insurances and building businesses, and custom live streams in that group. All of that for which we're changing the pricing for likely after this live stream here. But anyway, take a look at this. This chart, when Janet Yellen was talking, is basically what crashed the market because, like this guy says, she was honest. So look at where we are here. Here, we had that classic W shape of Jerome Powell. This is what happens. The market goes up when the press conference comes out, the statement comes out, rather. So the data comes out, the statement comes out. The market actually rises, so it goes up. After it goes up, it comes down a little bit. Then it comes up going into the presser. Then it goes down, and then it tends to close up. We tend to have a W shape. Unfortunately, Janet Yellen came out and said the truth that no, we're not backstopping banks, and markets cratered after that. I mean, the last 15 minutes of the day yesterday were a complete disaster while Janet Yellen was testifying. And so the individual we just saw in the interview, he's like, look, Janet Yellen said the truth. What's the truth? Well, the truth is simple. And the truth hurts, but it's very simple. No backstop of all deposits. That's what Janet Yellen said. And this is the first time we've really had this split screen event where you have Janet Yellen talking at the same time as Powell. And they didn't have a phone call first to discuss being on the same page, because Powell comes out and says, your deposits are safe. And then he's asked about it. Are you sure? And he says, all I'm going to say is your deposits are safe. We have the tools. Janet Yellen's like, nah, we're not going to extend FDIC. And so what did this former guy from the Bank of England say? Dude, in that case, go to Bank of America. Like, basically get out of the small banks and go to the big banks. It totally makes sense, especially if you have more than the FDIC limit, right? Of course. But that's what we've been talking about for quite a while now. That's just the way the game is played. And so that created some stress in markets yesterday. But I actually agree with the individual that we are likely to see inflation plummet. Every leading indicator I look at, leading indicator, not this lagging crap of these reports, but I'm talking company earnings, companies' forecasts for hiring, what sentiment is on the ground, what business owners are doing in regards to hiring, the availability of labor, not the stupid JOLTS data survey that says, oh, there are all these job openings. Bull crap, man. Talk to people. How many remote job opportunities are there? They're dwindling. How many opportunities are there for getting jobs at tech companies? Very few. How much competition is there for tech jobs? Massive. How many applications did Cloudflare get last year for 1,300 job openings? 400,000. There is a glut of labor supply. That's why you're seeing so much extra driver availability at Lyft and Uber, the likes of which we haven't seen before. And it's leading to a reduction in earnings for companies like Uber because you have no more peak pricing because there's no peak. So it's kind of remarkable, the availability of labor supply that you're seeing, and that's deflationary. As is obviously autonomy and automation and other leading factors we're seeing. By the way, and this is just sort of a side rant, what the hell, Airbnb? You want to rent an Airbnb for like $250 a night because it's like, oh, the hotel's $250 a night, the Airbnb's $250 a night. Then when you get to checkout, it's like the $250 turns into like $600. It's insane. Oh my God, the amount of extra fees that are added on now are just absolutely ludicrous. I feel like rather than paying for like a room tidy up, I'm literally paying for house cleaners to do a deep cleaning of the entire house. It's insane. But anyway, back to this, what this individual says. He's totally right to say, look, we're probably walking right into a recession. And the fact of the matter is, I think the easiest thing you could do is look at Jerome Powell's response to a question like this one. I think this was a good question. Watch this response right here from Jay Powell. And he totally dodges the guy when the guy's like, are you just basically giving us another false sense of hopium? Listen in here.
That's just something that will have to come through softening demand and perhaps some softening in labor market conditions. We don't see that yet. And that's of course, 56% of the index. So the story is pretty much the same. I will say that the inflation data that we got, to your point, really pointed to stronger inflation.
If I could follow up on that, I was curious why you don't see more coming from the credit crunch, because it seems to me that's something that you'd actually welcome to a degree and expect. And are you not seeing more coming from that because you don't know, or because you just don't want to have another round of wishful thinking?
So
it's kind of interesting here. Another round of wishful thinking. So in other words, sort of making this argument of here, hey, like Jay Powell, why don't you think this credit crunch is going to hurt us more? Do you really think you can make an excuse that's going to say, oh, our market's not going to crash because you think inflation is slightly still trending up? And now we're going to have this wishful thinking that we could continue to hike and damage this economy and push us into a deep recession because you had an inflation report that showed 0.04% or 0.4% month over month inflation. Come on, Jay Powell, like you're losing the plot. The credit tightening that we're going to see could be as painful as a 1.5% rate hike, at least according to TS Lombard. They think that could be anywhere between 0.75 to 1.5%. That means we're knocking on the door of 6% interest rates here. That's insane. Of course, Jay Powell's response.
It's really just a question of not knowing at this point. There's a
exactly
great deal of literature on the connection between tighter credit conditions, economic activity, hiring, and inflation. Very large body of literature. The question is, how significant will this credit tightening be, and how sustained will it be? That's the issue. And we don't really see it yet. It's so people are making estimates, people are publishing estimates, and But it's very kind of rule of thumb guesswork almost at this point. But we think it's potentially quite real, and that argues for being alert as we go forward, as we think about further rate hikes. For us, we'll be paying attention to the actual.
All right, we'll be paying attention. Blah 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 blah. Okay, so you kind of get it. It's basically like, yeah, we don't know. Okay, but we already know that. So now here's another thing that a couple things that are interesting. So I want to address this one comment here about lower wage workers seeing wage hikes, and there's this comment here about cleaners. But first, I want to respond to this person. So this person's name, looks like Gag. It's either two boobs and a 4 in between, or his name's Gag, or her name. I don't know who this is. But anyway, this person says, friends don't make you pay for information. A friend shares information that could change your life. Kevin is not your friend. He could share this info on YouTube freely. His videos are an advertisement. Wow. So let's break this down. First of all, how many YouTube videos are on my channel? And how many hours of content are freely shared on my channel? The answer is thousands and tens of thousands. That is thousands of videos and tens of thousands of hours of content are available on the channel. So that's A lot of information is shared freely on YouTube. The next issue that you didn't address is the fact that people are willing to pay for information that isn't available on YouTube or readily available on YouTube. Let me make that clear. The reason I have courses is twofold. Number one, it organizes information in a row for you, so that way you can actually understand it and build your information together. Like if you watch a real estate 101 video and then you go to a real estate 110 video, well, now you've lost context, right? And that's kind of what YouTube is. It serves you up really basic and then really complicated. You don't even know what you don't know when it comes to investing in real estate. And so the beautiful thing, in my opinion, about courses is this organized structure for actually learning a download of how somebody views the world and gets perspective in order, and in a way that actually teaches rather than in a way that gives you information that potentially is more scattered, right? I mean, many of you know, I'm a big fan of wedge deals in real estate. Many of you know a lot of my principles, but that doesn't mean they've been taught in a way that's organized that you could adapt as easily as you could in a course. Now, sure, can we make videos on that? Yeah. But that's what the course is. The course is 40, a lot of the courses are like 40 hours in a row of that kind of content. I can't make a 40-hour long YouTube video. I can make 41-hour videos, but again, the way the algo serves it to you isn't that good. That's A. And then B, wow, how dare a YouTube content creator try to make money? You know, I really think this idea that people, it's evil for people to make money is really stupid. I don't know what's gotten into people's heads in America lately, but there's been this vilification of capitalism. It's really disappointing and saddening, because capitalism is disinflationary. The fact that you could learn how to be a millionaire in real estate for $400 through a course, rather than going to college for 4 years or and spending 40 grand, is insane, and they don't even teach you that stuff in college. So the capitalism is so wonderful, and we should really be proponents of capitalism and people making money. There are ways to have win-win products and services, right? I think people have this inherent aversion for some reason of, oh, well, I won't click that person's link because they might make money. Why is that bad? When somebody makes money, they're motivated to continue providing you a good or service and making it even better. So I don't know what this weird aversion to capitalism is. It's like people who are like, oh, I don't like your real estate startup because you're going to make housing unaffordable. And I'm like, what are you smoking? What makes housing unaffordable? The lack of rental supply for renters. What is my startup going to do? Take houses that are uninhabitable, like hoarding houses or fixer-uppers, and bring them to the market, and then potentially add casitas. So you're going from 0 homes on market to 1 to 2 to 3 homes on market per property. Like this vilification of capitalism and investors is so backwards and contorted. I don't know what's being taught in schools, if it's just a lack of being taught in schools. I think there's a lack of logic that's being taught in schools, and it's sad. It's really sad. And look, I'm not saying that, Jay Powell has all the answers or he doesn't have all the answers. He just told you himself he doesn't have all the answers. I'm not saying I have all the answers, but the critical thinking that's missing in the world today is very sad. But going back to this hotel comment, because I actually think this is a very reasonable comment. So Tom Baker here says, I'm in the hotel business and it's next to impossible to hire cleaners paying $18 per hour. Rates for rooms are going up. So this is actually is something that I think is very important to talk about when it comes to the topic of inflation. And I think it's useful to look at it, on screen here. So what I would say is if you go in and basically say that the typical wage you would pay for a manual laborer is $14, let's say, and maybe now you have to pay $18. That is absolutely inflationary to you. That makes your costs of business go up. Now, that makes you desire to raise your room rates, but your room rates, your $250 per night hotel room, is not predicated on what your costs are. That's not how capitalism works. Your room rates are predicated on demand. So if demand for your rooms go down, you have to lower the price, and that means you eat the difference in costs. That then creates a lower margin business, and it basically pushes inefficient businesses out of the market. Now, just because Walmart and McDonald's are raising wages does not mean we have a wage price spiral. After all, the average wage in America is $32. Well, if the average wage in America is $32, even if you see lower wages go up and you have more of those, you're actually potentially dragging average wages down, especially if you're losing higher paid wages, right? So that's another aspect to consider when it comes to inflation. What's the best way to ask for a wage? I would say wait right now. I mean, we have a lot of strategies for that in the Elite Hustlers group, but this is probably the worst time to ask for a wage because it's such an uncertain time. I think one of the best things to do right now is make sure you are invaluable to your boss. Now, I get this all the time. People are like, oh, but does my boss see the value I'm providing? I guarantee it, your immediate supervisor, whoever that is, whether that's the owner of the company, your supervisor, whatever, sees and knows which workers work the hardest. They know who's sitting on their phone all day long and who is actually grinding all day long. And those people who grind will always end up getting rewarded. I'm highly confident of that. Our media and schools are corrupted. Probably. So I start my new career and job on Monday. Congratulations. But yeah. Anyway, so these are interesting things to keep in mind. And I think it's very interesting about what this Bank of England individual said regarding Jerome Powell. I think he's right. I think he's absolutely right that Jerome Powell is leading us into this tightening cycle that's going to push us into an ugly recession, sadly, and it's very unfortunate. Hopefully that recession is very shallow, because if the recession is not shallow, all stocks are going to get reamed. If the recession is shallow, then I could play music for you and basically hope that pricing power stocks continue to do very well, and we move on. That's the goal. So anyway, check out those links down below for life insurance by going to metkevin.com/life, metkevin.com/free for 12 free stocks from Webull. Yeah, there you have it. Now I've run out of things to say while my music is playing. I'm hoping to get to the end of that music because I think it's kind of cool.